It's great to be with you and be part of this event today. We have a great group of people to talk about this very important topic of financial inclusion during COVID-19. What are the lessons and what are the challenges? I'm joined by Amolo Ngueno, who is the CEO of BFA Global, which is a consulting firm working on financial inclusion and many other topics. And Stanley Munyao, who's the CEO of Musoni, and he's been there for 4 years. And thank you to Stanley, who's joining us from leave to be a part of this important conversation. And we're going to start with my colleague, Anzetse, who's the senior economist at FSD-Kenya, and she's going to start by giving us a bit of a context-setting discussion on this topic. So over to you, Anzetse.
Thank you, Tamara, and thank you, Afro-Asia Fintech Festival, for providing me with this opportunity to speak. So I think really the reason why this context setting is important is because of the implications for recovery in terms of not only financial inclusion, but also financial health. So I think if you're looking at the impact that COVID has had on countries like Kenya, I think there are really two stories that we're seeing happening. I think on the macroeconomic level, if you're looking at things like GDP figures or things like inflation figures, it looks like Kenya is demonstrating relative economic resilience. If you compare the contraction at which our GDP underwent in Q2 compared to some of our peer countries or even some of the larger economies, Kenya actually performed quite well. But actually what we're actually seeing from a perspective of financial inclusion and health is that, first of all, there are very deep differences in terms of the way different sectors have been hit by the pandemic. We have found that some sectors are being disproportionately hit, such as tourism, accommodation and food services, sectors such as education, transportation and storage, sectors such as trade. These have really suffered massive contractions. And the reason why that's important is because a lot of these sectors are very labor intensive. And so you're finding that a lot of people are finding that their incomes have really fallen off a cliff. That's the first big impact that we're seeing, is the differences in sectors. The second big difference we're seeing is gender. We're finding that women are being disproportionately hit, partly because the bulk of the sectors where women earn a living, such as trade, such as tourism and restaurants and even education, those are the sectors that have been really hit. But we're also finding that a lot of the policies that are being structured do not necessarily have a gendered view. The other big way women are being hit is because we're seeing elevated levels of violence being targeted against women and children during this time of COVID. So as a result, we're seeing there's one part of a story that's saying, there's resilience being demonstrated, but we're seeing that the disproportionate effect is one of devastation. If you're looking at job loss, we're seeing losses in both the formal and informal sectors. We're even seeing people who used to be economically active, maybe self-employed, now not being economically active. And the biggest issue that we're finding that particularly businesses are having, micro, small, and medium enterprises in particular, is a lack of demand. Customers aren't buying as much, customers are not buying as often. And that's partly because of the income shocks that those customers are having. And so we're seeing just this continued dampening. Even as we're seeing slow signs of recovery, it's not going back to the pre-COVID levels. So the big story, I think, if you're talking about an inclusion story, is we're seeing a lot of income divergence. The bulk of Kenyans, and I think many across Africa, have had their incomes completely decimated and are really in a survival mode of trying to do what they can to make some income. But on the other hand, we are seeing a very thin layer of Kenyans that are demonstrating resilience, that are either in sectors that are still ticking on, or are in jobs that allow them to continue to earn a living. And from an economic point of view, we're seeing an economic dualism. So you're seeing some economic sectors that are demonstrating resilience. We're seeing things like ICT. We saw agriculture do fairly well. Then we're seeing the other side, which is many economic sectors that are just sort of really struggling to recover. And in terms of going forward, there really will be four main pathways through which we'll see recovery. Some will bounce back, some will turn out stronger than before if you're looking at sectors like the ICT sector that's relevant here. But there'll be some where there'll be very lengthy recovery and some may not recover at all. So when you're looking at headline inclusion, There are rising poverty numbers. I think the World Bank just released a report that in Kenya, there are about 2 million that have already sunk into poverty or at risk of sinking into poverty because of COVID. But the biggest story, I think, from our perspective in FSD is we're seeing a real hit in financial health. And we really measure financial health in 3 ways, which is the ability to manage day-to-day, the ability to deal with risks, and the ability to invest in the future. And because of the way Kenyans' incomes have been lost, a lot of people are either going without food, a lot of people are foregoing medical care, a lot of people are actually selling their assets. This includes business assets. So when it comes to recover, that will be a struggle. And a lot of Kenyans actually spending their savings as well as accruing new forms of debt. So I think I just want to, as I start wrapping up, I want to really look at the role of digitization and the role of technology and why we've seen the rise of digitization in the context of COVID. Obviously, COVID-19 is spurring digitization at a much faster rate, and there are really 3 main reasons because of this. Obviously, the social distancing protocols is one thing. I think the other big thing is that a lot of governments have encouraged a pivot to using digital channels such as mobile money. And also, because of these factors, the ICT sector is actually being seen as a sector that is more resilient, more prosperous. So we're almost seeing a crowding in effect in terms of interest, whether that's investor interest, development finance interest. So we are seeing this confluence of factors leading to that. But I think there are reasons to be cautious, and there are really 4 reasons. I think the first is different Kenyans and different businesses in Kenya, in Africa, have different starting capabilities in terms of their access to digital tools and in terms of their access to digital capabilities. So when we're doing this pivot to digitization, you have to bear in mind that there are many Kenyans and many Kenyan firms that do not have as deep digital capabilities as others. So there is an uneven playing field to start with. I think the other thing is to do with costs, and I believe Dr. Verasongwe mentioned this a bit in her remarks. But what we're seeing is that you need a certain amount of financial bandwidth to meaningfully leverage digitization. So whether you're a small firm or a large firm or a medium firm operating in Africa or in Kenya, you need a certain amount of financial bandwidth to meaningfully make a pivot to digitization that makes sense. So the risk there is that those with lower incomes or those firms that are not doing so well won't be able to leverage it. And I think finally, just the issue of digital skills, where it's not even across the board, either at firm or household level. So I think just in terms of a few ideas, as we're talking about recovery, and how to make sure that recovery is inclusive, I think the first big thing is a lot of effort has to be targeted at low-income Kenyans. That is not necessarily where the market may want to play, but that is where the help is needed. I think if you're looking at it from a business perspective, any stimulus effort going forward should look at a way to build back demand so that businesses have customers again and customers can come back in and buy what they need. I think we also need to look at very specific policies to target feminized sectors or sectors where women in particular earn a living. And finally, I think we need to start looking beyond financial inclusion to financial health. So even as those responses, again, are being targeted, looking at maybe even the sectors that do need a bit more help than others. Because I think one thing that we've seen COVID tell us is that depending on where you are and where you're sitting, it will hit you very differently. So specifically because of that, I think digital finance across the board just needs to become a bit more affordable than it has been in the past. So thank you. With that, I'll end my comments.
Great. Thank you so much, Anzetse. That was a really helpful context setting. So I'm going to turn to the 2 panelists, Stanley and Amolo, and start with you, Stanley. Shortly after COVID hit, you and I had a conversation about how Musoni was handling the pandemic and how you were having to pivot your model and how that was going to work. And I haven't heard from you lately, so I'm looking forward to an update on how things have been going and how you've had to continue to pivot and change due to COVID-19 so that you can really serve the clients that are your bread and butter, that's who you exist to serve. But not only how do you serve them, but what have you learned from these pivots and these changes in interacting with your customers? So Stanley, welcome. You're still on mute, Stanley, if you could unmute.
Thank you very much, Tamara, and good to be in this panel and talk about the measures that Musoni has taken to cushion its customers during this pandemic. as we all know, really, the health pandemic plus the lockdowns that have been put in place have severely harmed, the livelihoods of low-income people in our societies. But even much more worse because their cash flows have been completely impaired, and survival has become more severe than in the past. So as Musoni, we looked at the role that we play in the financial inclusion space, being a technology-driven company that promotes financial inclusion in the Kenyan market. So through that, we were able to establish that we are actually an essential service provider in Kenya, and our services were much more needed now than before. And we categorized, the key areas of focus into three. One is how to manage our staff. Secondly, how to manage our customers. And third, how to manage our external stakeholders, and especially those who provide funding to Musoni for purposes of extending financial services to the less fortunate or excluded. But for today, I'll focus on the first two, staff and customers. So we first and foremost made sure that all our staff are well taken care of, safely working from home, not really moving up and down in compliance with the government lockdown regulations, but still continue to reach out our customers from wherever they are through alternative channels. And that was well taken care of, and I'm happy to share with you that we've been able to take care of our staff all through the last 6 or 8 months of lockdowns. But the customers were the biggest challenge for the institution, noting that their continued access to financial services, both financial and non-financial, was much more needed during the lockdown periods, when they could not trade, when they could not go to markets, when they could not, access, markets for their products and stuff like that. So we moved more into digital services just to make sure that we keep these customers engaged. And social media played a very key role for us. We do what we call group-based lending methodology. And we were able to put our customers in WhatsApp groups so that they can continue chatting and getting to understand how they can access services, how they can access markets, and how they can get their issues sorted out promptly from Musoni. The other issue that we looked at more keenly was client protection, because we anticipated probably an increased level of client exploitation during this period of time. And fortunately, Musoni had just been smart certified by Microfinance as a responsible institution within the financial inclusion space, and we wanted to make sure that our customers get to know their rights during these difficult moments. If you've got facilities that you're unable to pay, what are the alternatives that are out there? Can you get your facilities restructured? Can you get refinanced? And if you need access to more working capital, are you able to access those facilities? But more so also exposing them to digital training so that they are able to deal with their colleagues, with their peers, conveniently in a digital manner. And that, again, we kept them engaged all through. And I'm happy to say that if we look at the level of satisfaction of our customers, which we do regularly or on monthly basis through, customer satisfaction surveys, we've seen a large increase in the level of satisfaction of our customers from an approximate of 60 to upwards of 80% due to just the engagements that we've been able to walk them through this period of time. Thank you, Tamara.
Thank you, Stanley. That's really interesting. When we were first speaking about this, you talked about the challenges of who had a phone, was it a smartphone, who had data, and I know you tested, you mentioned WhatsApp. I think you've also used Zoom for the digital training. How did it work? How many customers had a smartphone, or how did they need to share? How did you make that work for customers so that they could engage with you in this new way?
Yeah, approximately 70% of our customers now have access to smartphones, even though they are rural-based. And ownership of a smartphone isn't the biggest challenge. The bigger challenge is access to data bundles to keep them engaged. Because we do have customers even who constitute the 30-40% without smartphones, but they have access to a smartphone either from a relative, from their kid, or from a neighbor. So we engaged in an exercise of providing our customers, selected customers who are unable to get data bundles with bundles of approximately 100 shillings, Kenya shillings. That's about $1 when we want to engage them. And we knew it was an expense from our side. It was a cost when institutions are looking at how to minimize cost, but it was having a long-term benefit to the institution because through the Zoom organized trainings to our customers, through the WhatsApp group meetings that customers from the comfort of their homes could still convene as a group and engage with their loan officer, engage with their relationship officer in Musoni. That made the big change in it. And most even moving beyond provision of financial training or literacy training to even educating our customers and demystifying the COVID-19 pandemic for them and emphasizing the need for them to stay safe, why they need to wear a mask, socially distance, and sanitize as frequently as possible and keep most of, what I would call unwanted visitors away from their homesteads. Approximately 50% of our customers, Tamara, are aged 50 years and above. And that means they're within that age bracket that is potentially exposed to COVID-19. So this kind of training was very, very important for us to make sure that at least all our customers are safe and well taken care of. We were also tracking the level of exposure or infection rates on our customers throughout this period. And I would attribute this on top of what the government of Kenya has done to educate Kenyans about COVID-19, the concerted efforts that Musoni put in place are seen a very low, probably, infection rate on our customers in our database that we've been able to pick. Because out of 75,000 customers, we cannot talk about less than 10 customers who have reported to us that they've been infected with COVID-19, all because of these concerted efforts that we've deployed.
Thank you, Stanley. Musoni has a reputation of being a digital-first financial service provider. And yet what I'm hearing is that it may be digital, but it's also very relational. The digital, and I know previously the model was digital plus physical meetings and, these meetings with the groups and with the relationship officers. But what I'm hearing is that you've even been able to leverage technology to make sure that relational aspect of your model is still very strong. Let's go to Amolo. Amolo, you have worked a lot in Kenya, but you also run a global firm and have worked on the topic of COVID-19 and financial inclusion across many countries. What can you share with us that you've seen? What lessons have you and your colleagues been learning during these crazy times?
So thank you, Tamara. I think Anzetse has actually mentioned quite a number of things that are common across the world, and just starting with that dual track recovery, that there are certain sectors that are recovering strongly, and we see that a lot in East Africa. The agriculture sectors bounded back, but in many countries there's this thin layer of the ICT digital enabled businesses that are doing quite well. Those include e-commerce, delivery, the whole set of new digital economy activities. And of course, obviously, there's tourism and travel and a set of other things that are doing, much worse. And I think now with the vaccine on the horizon, I think some of those industries are starting to gear up or think about potential recovery. But I think all the points she's made, and we've seen this again across the world, about people drawing down their savings, spending their assets, drawing their credit to their maximum amount, and also lacking some of those social connections that are incredibly important for low-income people, typically when they need money to cover a disaster or a shock, or if they need money to start a business, they borrow in their social network. And of course, the social network has also been drawn down. So people are therefore finding it harder to come back than from any shock that would just be individual to me. Nonetheless, though, I will say it's been quite encouraging to see that, well, as we mentioned, agriculture, which was very disrupted in the first days of the pandemic, rural markets and transport being disrupted, and I think quite a bit of concern about food security in rural areas, but agriculture returning pretty strong. And we've all learned, all urban people have learned what agriculture really is. But some of these informal sector activities, petty trade, small-scale manufacturing, small-scale restaurants, those are also coming back despite all those financial health hits that they've taken. So there is some possibly more buoyancy and resilience, in fact, in the informal sector than many formal enterprises. So I think there's certainly earlier we were very concerned that those sectors would fall behind, as government programs are all aimed at formal enterprises, formal financial systems, and therefore employees in the formal sector. I think it's still an ongoing concern, but the complete disaster that we really feared in the informal sector hasn't yet materialized.
Stanley, are you seeing similar differences in the sectors that your entrepreneurs are involved in? Are you seeing that some are able to bounce back a bit faster or some are struggling? Are you seeing this agriculture versus some of these other sectors in your customers?
Absolutely right, Tamara. One of the reasons why we've been able to remain a little bit stable is our heavy investment in agriculture, and especially smallholder farmers in rural areas who have remained relatively stable during this period of time. And that has also informed the direction that we as Musoni want to take into the future, dealing more with smallholder farmers, because the largest society has to feed, and they've got to get foodstuff which is produced by smallholder farmers, and the smallholder farmers need financial institutions that can support them, and that's where Musoni comes in Adi. We also have some sizable operation in urban centers where we deal with traders, restaurants, small shops, businesses of that nature, and those have been hardly hit to the level that we are looking at how to support them get out of their current situation, because most of them have lived on their working capital, especially during the lockdowns, and those businesses are completely shut. And a partner who can help them bounce back into operations is much needed today. Let me put it differently. We, from a macro point of view, we are talking about stimulus package for different players in the economy. For us, our view is a little bit different. We are looking at who's going to be there to support small-scale entrepreneurs who may not qualify largely for these stimulus package initiatives, but just need some little working capital to get their businesses back on their feet. And we are focusing on getting it right and ensuring that we play that critical role, so that together with other players in the space, including the government, we're able to get this economy back on track as soon as possible.
Can I just add something just to build on what both Amolo and Stanley are saying? I think one of the things that we are trying to unpack is what are the drivers of that resilience. Yeah. So on one hand, because I think the story now is that Africa is far more resilient. Kenya is far more resilient than we'd anticipated, and there's truth to that. But I think we're finding that there are two stories happening. I think one is that there has been an ability for those with certain sectoral exposure, existing digital or financial capabilities. There's been an ecosystem of factors that allow them to be resilient in a healthy manner, in a manner that has not compromised their welfare. But what we're also seeing, quite worryingly, is that there are people who look like they're doing fine, who look like, they're getting food on the table, particularly women, who look like, everything is fine, but it's costing them their business assets, it's costing them their savings, it's costing them foregoing their medical care, it's costing them missing meals. So you can look at the images that, they're resilient, they seem to be ticking on just fine. But actually, the question is, well, how much longer can that type of resilience continue before people really fall off a cliff and sink into very, very deep levels of poverty? So I think that's where, from an inclusion perspective, we really need to start getting to the details of that, so that the people who are demonstrating a resilience that's backed by healthy fundamentals, that should be encouraged. But by those who are demonstrating resilience that's very, very unhealthy and dangerous, the support can come in and give them the help that they need.
And if I could just add, I completely agree with you. And I think one of the things we're also worried about is that those people who are coming back may be coming back with a huge debt overhang. And that will make it more difficult for them to reinvest in their business and in employment and in growth. And yet, a lot of that debt is probably informal and invisible. I see Stanley smiling, so maybe you're seeing this, but maybe you're offering better alternatives to that high-cost informal debt as well.
No, Amolo, you are absolutely spot on this, and we've picked it up because, and the Central Bank of Kenya did communicate about, did provide a guideline around, credit reference bureau listing and all those things. So we are seeing it in the ecosystem that we're operating in, and more and more customers in our space are getting exposed into credit that is geared towards consumption purposes and not wealth generation. And inability to pay is prevalent, is increasing every other day. Those customers either end up being listed in credit reference bureaus, and if you're not careful or responsible enough, then you end up pushing them off the cliff that Anzetse is talking about, of financial inclusion. So we need more of very financially responsible players in the market to recognize that the landscape has been different. And that customer who has got a defaulted loan from a mobile lender or a small amount of loan that is late doesn't mean that it was a deliberate default or late payment. It is circumstances and conditions that were harsh for them, and they need more support, pushing them towards the financial inclusion side other than towards financial exclusion in order to get them back on their feet.
Stanley, what have you seen in your own portfolio? Have you had to reschedule loans, or are you seeing repayments suffering, what are you seeing among your own clients and in your own portfolio?
Yeah, I mentioned earlier that we've seen a lot of impairment of cash flows from our clients who are business people. So when their cash flows are impaired, it means loan repayment becomes secondary, if not tertiary. So they've got basic needs. They need to place a meal on the table. They need to take care of medication and things like those. So we have seen lots of partial loan repayments. That has made that we consider restructures of facilities or refinancing of those businesses. But yes, so far we've restructured approximately 30% of our loan book in order to make it easy for customers to continue with their operations and under less stress. We've, as I mentioned earlier, we are also SMART certified in terms of client protection principles. Mm-hmm. So we've been very careful on how we engage our customers during this period of time in terms of recovery and pursuit of loan repayments. And this has been done more in line with client relationship management, other than just going out aggressively to pursue your collateral and stuff like that. And this has made our customers appreciate the services that we are offering to them, and also come forward and give us better business proposals on how they intend to resume their businesses, or how they intend to stabilize their businesses as we now learn how to live with COVID in our midst. But one more thing that that we've gotten rid of entirely is Credit Reference Bureau, because out of 10 customers, approximately 7 or 8 are listed negatively in Credit Reference Bureau, and that won't help if you cannot extend services to them.
Mm. So I just wanted to say that I was pleased to be at the launch of the Smart Certification for Musoni. You were the first in Kenya to get that global certification. I think it was a good, it's a testament to how much you value your customers and really want to see them thrive. And what I'm also hearing is it's not about their willingness to repay, it's really about the ability. And this idea that you work with your customers to come up with payment terms that work for them and for their businesses and for their families, I think is a testament to Musoni. Amolo, we've been working with you over these last few months on the COVID diaries and the waves of different interviews. And we've seen different things happening in those diaries, interviews from, kind of wave to wave. What are some of your takeaways that are kind of related to the topics we've been discussing of how that's changed over this period?
I think the COVID diaries is a set of interviews that we've done with people who participated in the Kenya Financial Diaries back in 2012 and 13. And they're mostly rural, with 30% or so who live in low-income areas in urban locations. And I think the first thing right at the beginning, when we interviewed them about their situation at the beginning of the crisis, I think at the time people were saying that everything is fine in the rural areas to a great degree. And one of the first things that really stuck out from the diaries was that rural families were struggling both with the market and transport disruption, but also because urban people had left the cities and often without an income, and the children had come home. And so these families were trying to feed way more people than they were used to in an unplanned and crisis situation in rural areas. And at the time also we saw some really severe urban poverty because of job loss in urban areas, and that people obviously did not have farming to fall back on. So I think that was an insight into really the depth of the crisis. What we also learned at the time, some of the things that have now become well known and obvious, like Anzetse mentioned about the burden on women, the worries that families had about girls going back to school when the schools reopened. The families were very worried that their girls will be less likely to go back to school, and also worried that their teenage boys would kind of drift off the right path and into trouble. So I think subsequently it's been much clearer how hard that burden has fallen on women, and the dangers of and difficulties of bringing children at all back to school, and high school girls in particular. And then as the crisis has developed, we have seen some of that recovery that I talked about. Some of it because rural areas have maintained production, have been able to have access to markets, and because urban people have tested out new ways of making a living, even in this depressed economy. I think we will still learn more when we are finally able to meet them in person, which we're hoping for mid of next year, about their financial profiles. I mean, obviously their financial health has been severely dented, but in terms of financial instruments, what have they actually been able to do that has enabled some of that resilience? And then we've also seen that different areas are different. I think that's the urban Nairobi, it's recovering faster than certain of the rural areas, or the coast, which is very tourism dependent. So that type of research has really allowed us this in-depth view into a widespread and partially rural perspective, and it's certainly it reinforces what we also learn from other types of surveys.
And can I just add that to both? I think also what we're seeing is that financial health and financial inclusion will have a material effect on the quality of human capital going forward. So because a lot of incomes have been hit and because people are foregoing medical care, I think the ability of Kenyans to continue being productive, even when the recovery happens, we need to monitor that quite closely. But on the point about education, which is very important, a lot of the savings people have eaten into are the education savings for their children. Yeah. So beyond, sort of the issues Amolo have raised, which is around, will kids be able to go back to school? The question is, will parents be able to finance it? And in some of the work that we're doing a survey on low-cost schools in Kenya. Schools that charge about 30,000 a year, and their biggest concern is that even if they're open, parents will be able to pay the fees. And most of those schools run off of the school fees. So what we're actually going to see going forward, maybe a big crisis in the education of children because of how you've seen savings deplete and sort of the accrual of debt going forward.
Great. So we've had a fantastic conversation so far. Any last thoughts before we kind of move towards wrapping up? Stanley, anything from you? You're on mute still.
Yeah, I think for me, what is important, and for all of us, especially those who are supporting the bottom of the pyramid, small-scale entrepreneurs and businesses of that nature, is really to remain open and continue offering the services that are needed by these customers throughout this period of time. Then look at how you can provide relief to these customers, one way or another. It could be moratoriums, it could be restructuring of their facilities, it could be top-ups, refinancing. Let's think about all these things. And as Anzetse says, where else it looks gloom, it's very easy for these customers to bounce back if they are just given the platform to fix working capital needs for their businesses. Institutions of our nature will need to increase their liquidity and deploy more funding, especially in rural areas and informal settlements in Nairobi, and that will trigger, or spur some economic activity within that space. And then we're looking ahead to recovery, all of us. And if we can support each one of us in one way or another, then we should all be able to bounce back sooner than later. Thank you very much.
Great. Anzetse, Amolo, anything else to add as we wrap up?
Yes, I just want to say something about digitization because of the role that digital, particularly digital finance and mobile options are offering people. Just people should, while developing those strategies, just bear in mind that people have different starting capabilities in terms of the access to digital tools. And just to the point Stanley made, that we've seen is that people's financial capabilities are really going to determine whether they can meaningfully interact with any of the solutions that are being provided. I think it's very important for firms to look at their pricing strategy, keep things as affordable as possible. And then finally, I think really looking at the digital skills and the ecosystem to allow the low-income Kenyans to leverage those.
Great. Amolo, any last?
Maybe just picking up on what Anzetse said, I think that we have seen this big wave of digitization, regardless of the starting point, but across many countries, and Kenya may be in the leading ones. And I think we need to track and manage in a positive sense the benefits that we can get out of that as the economy returns to growth. It won't be the old normal. I think we've spent at least a year by the time we released from some form of lockdown. And we should take full advantage of that digital opportunity, new digital skills. And I would love to see some direct government stimulus for this lower income, informal sector, small scale businesses and individual micro entrepreneurs, not just in Kenya, but across Africa. Government stimulus has been way less than in many countries, and it would be great to see that jump up and boost the recovery.
Great. Well, thank you for an excellent conversation on financial inclusion, the challenges and the lessons that we've learned. I think there are many themes that came out, but I think a couple that stand out to me are the power of digital, but also how that needs to be managed in a way that we recognize where people are coming from and how they are set up to take advantage of that. The way we can use digital in new ways, as Stanley told us about when they helped make some of their relationship management go more digital, and how different sectors, different parts of the economy are going to come back differently, and more, as Amolo has just said, the informal sector, the micro and small and medium enterprises, those who are the least advantaged, are going to need more help, and we hope that financial inclusion can be a part of that story. I would like to congratulate the government yesterday on the launch of the credit guarantee scheme, which is targeted at micro, small, and medium enterprises. And I'd like to end by just thanking Amolo, Stanley, and Anzetse for your wisdom, and thank FSD-Kenya, as you may know, is an independent trust here in Kenya. We're part of a network of FSDs across Africa. And we thank our partners who made a lot of the research you heard about today possible, which is the Bill and Melinda Gates Foundation, Swedish SIDA, and UK Aid. So with that, I think we will thank our colleagues at the Central Bank of Kenya and Naz for inviting us to have this conversation with you, and we hope you found it as useful as we found it interesting.